This is our discussion of Chapter 13. I'm going to refer first to the Chapter 13 outline. Then I have one illustration from the book, which I will also be using. So here in Chapter 13, overall audit planning, we have what is largely a review chapter. So not a bad chapter whatsoever. It will not take long to cover either. We will review the types of audit tests we have. We will see how those are put together in an audit program. And then we will have a small overview of the audit. So first of all, the types of audit tests. We have 5 major ones. And the first, analytical procedures. We covered these in Chapter 8. We know these are things such as financial ratio analysis. They give us a quick and easy overview of where things may be good or where things may be bad in the way of financial statement misstatements. Then, procedures to obtain an understanding of internal control. We cover these in Chapter 10. We do these quite early in the audit so that we know how good or how bad internal control is. And they are to obtain an understanding of the controls and to determine whether they've been put in place. They will allow the auditor to assess a preliminary value for control risk. Then, if we think that preliminary value for control risk is going to be below 100%, we will go to C, where we conduct tests of controls. We also saw them in Chapter 10. They will allow us to assess a final value of control risk, and possibly lowered from the default value of 100%, thereby reducing substantive tests, especially tests of details, which are usually relatively expensive. And tests of controls are to test the effectiveness of the controls. We've also seen D, substantive tests of transactions. And they are to test for monetary errors, which could either be unintentional errors or could be fraud, affecting individual transactions because we examine one transaction at a time. And they will reduce tests of details if the results are good. We've also seen that they may be combined with test controls as a dual-purpose test. And the text often refers to both substantive tests of transactions and tests of controls as tests of transactions, since we are testing one individual transaction at a time. We've also seen E, tests of details of account balances, and they are to substantiate the ending balance of an account, especially the real or balance sheet accounts. We note that it's important to perform both substantive tests of transactions and tests of details due to double entry accounting, as well as to the carryover of real account balances to the next fiscal year. The auditor wants next fiscal year's beginning balances to be quite accurate. So that's one reason that we want this great accuracy the test of details will give us for those real accounts. And there are no tests of details for most nominal accounts because their balances are closed out to the real accounts at fiscal year end. And figure 13.2 on page 411 summarizes the roles the types of audit tests have in auditing accounts. If that figure helps you, that's great. If not, that's okay too. With F, relation of types of tests to ways of gathering evidence, you might just want to briefly take a look at Table 13.2. I won't test you on that, and I won't test you on the previous table either. Then in G, if we think about the cost of tests, if we go from lowest to highest, so in increasing order, cheapest analytical procedures, things like financial ratios are cheap, quick to do, that's why, time is money. Then test controls and procedures to obtain an understanding of internal control, sort of a toss up there. Then third, substantive tests of transactions, more expensive. And why is more expensive in most areas? Tests of details. So we try to save those until the end, hoping that we save on those, not having to do as many, because of good results from the other audit tests, which we usually do before tests of details. And that's a general guide, can vary according to account or client. And we can note the more precise information is generally provided by the more expensive tests. Tests of details give us very precise, accurate information, but they do cost. So shall we say we get what we pay for? Then in H, variation in audit plans. I'd like to go to Table 13.3 with you on page 418 and make sense of the mix of evidence to be gathered for these 4 clients here. So let me show you this. And variations in evidence mix, 4 clients. In audit 1, we had extensive test of controls, small amount of substantive tests of transactions, extensive analytical procedures. I don't know why they said substantive analytical procedures, because analytical procedures, since they involve dollar amounts, are always substantive in nature. And a small amount of tests of details of balances. Well, this is a good audit client. With internal control, control risk must be quite low, and the extensive test controls proved it. With analytical procedures, I think these turned out just fine. Therefore, based on the good results from those 2 tests, the auditor could do fewer of the more expensive types of tests. So fewer substantive tests of transactions, a small amount, and what really saves money, a small amount of tests of details of balances. And I'm sure those turned out to be quite well off as well. So I think that that's a good audit client to have. That is an efficient audit. So being an efficient audit, it's a relatively inexpensive audit too. Now audit 2, medium test controls. I can assure you in audit 2, the control risk is higher than in audit 1. It was quite low in audit 1. Audit 2, it is more because they only did a medium amount of test controls. In audit 2, they did a medium amount of substantive tests of transactions, extensive analytical procedures, medium tests of details of balances. So with control risk, it's higher than in audit 1, but not horrible. This is why they did more substantive tests of transactions than in audit 1 and more tests of details. My guess is they were okay, but the results were not as good as those of audit 1. Same thing for analytical procedures. They turned out okay, but not as good as in audit 1. So audit 2 is a more expensive type audit. They did more of the more expensive tests. And in audit 2, the results of this audit were not quite as good as in audit 1. The client in audit 2, I'm sure, had some things to fix, some audit adjustments before they got a clean opinion. Now audit 3, there are no test controls. This is a signal that automatically control risk is 100%. They did extensive substantive tests of transactions. Makes sense because control risk is 100%. Medium analytical procedures, they figured why bother with a lot? Because we're going to do these very expensive substantive tests of transactions and extensive tests of details. Extensive tests of details, again, were because control risk is 100%. So in audit 3, this is not as good a client as in audit 1 and audit 2. My guess is that the substantive tests of transactions, analytical procedures, and tests of details did not turn out with results which were as good as audit 1 or audit 2. Audit 3 is a more expensive audit because the auditor did fewer of the cheaper tests and more of the more expensive tests. Then audit 4, medium test controls and extensive everything else. Well, my guess is in audit 4, they got in there and they found, as they tested internal control, that it was not as good as they thought. I especially say that because also early in the audit, they did analytical procedures, and those tests did not turn out, I would say, too terribly good. So control risk, I would say, is fairly high. And again, analytical procedures were not as good. I think they got a little surprised here. They thought that the audit would be better than it really turned out to be. So since things were not going so well on tests of controls and analytical procedures, they did extensive substantive tests of transactions and extensive tests of details of balances. I think they found some problems. Audit 4 is the most expensive audit yet. They did, again, not that many of the cheap test of controls, but extensive everything else. And these extensive tests of details definitely drove the bill up. They did as well on audit 3. With these audits, as we go down the list, these audits get more expensive. So audit 1, not nearly as expensive as an audit 4. Okay, let me turn back here to the outline itself and look at audit programs. And just a little bit of review of this. We know the phases normally include procedures to obtain an understanding of internal control. We do those very early so that we know where we have problems. Then tests of transactions. By the way, both test controls and substantive tests of transactions. Analytical procedures. The bulk may be performed earlier, some performed again at the end of the audit. In fact, what is required is we do analytical procedures at the beginning of the audit and the end of the audit. Most we do early on in the audit so that we know where problem spots are. Definitely, we try to save tests and details until the end because they are the most expensive type of audit test. Then, Roman numeral 3, overview of the audit. There's a diagram in your book. If that helps, that's good. If not, I will just walk you through relevant information for us. The first phase of the audit is to plan and design an audit approach so that we know where we're going. So it involves familiar things, obtaining an understanding of internal control and of the client, conducting background information, obtaining information about legal obligations, conducting analytical procedures and procedures to obtain an understanding of internal control, and making a preliminary assessment of control risk, acceptable audit risk, inherent risk, and materiality. We've seen all those things. In fact, everything in this section we've seen before. As I said, chapter 13 is largely a review chapter. Then B, the next phase would be test of controls and substantive tests of transactions. Well, tests of controls will determine the effectiveness of the controls identified in the first phase to allow a final assessment of control risk. And substantive tests of transactions may also provide some information about the effectiveness of the controls, but will mainly serve to provide evidence on the monetary correctness of individual transactions, because we are focusing on the dollar amount there and making sure it's correct. Both types of tests allow the auditor to determine the extent of the remaining substantive tests, and they may even be performed before fiscal year end if the auditor is confident the internal control is good. In fact, as we go through later chapters, some in this course, but definitely in the graduate level auditing course, we see some tests which can be moved up to an interim date, such as if we have a client with a 12/31 fiscal year end, we're really getting into busy season. If we could move some of those tests up to some earlier date, such as 10/31, 2 months earlier, we are in a less busy time there. And that would benefit us. We might even give the client a price break. And if it's a good client, what we see on 10/31 would still hold true on 12/31. We would conduct a little bit of testing during that 2-month period just to make sure, but at least we would be able to get the bulk of tests over with well before that busy fiscal year end starts hitting us. Then the next phase, we'll perform analytical procedures and tests of details. Well, as we stated above, the bulk of analytical procedures are usually performed early in the audit, even though the textbook may lead you to believe otherwise. And this is because the results of analytical procedures partly determine the extent of the other audit tests, especially tests of details. And most tests of details are usually done after fiscal year end, but analytical procedures may be performed before then. And in later chapters, we'll discuss some tests of details which can be moved up to interim dates. There we go again, such as October 31st instead of 12/31, to balance the auditor's workload. Again, if tests of details, such as confirmations of accounts receivable, check out as of 10/31, they should still be okay as of 12/31. And moving up audit tests to interim dates, by the way, requires the auditor or the client rather, have good internal control and low inherent risk and control risk. So it has to be a good client. Otherwise, the audit test will have to be performed closer to fiscal year end. And then D, complete the audit. We'll see more about that in chapter 24, which is the next chapter that I cover. I know it may look a little bit strange, skipping from chapter 13 to chapter 24, In reality, there's nothing in between which we need. Chapter 24 falls right in line here. Thank you for listening, and if you have any questions, as always, let me know. Thank you. Take care.